Welcome to the Deep Dive. We unpack complex topics, look at the source material, and try to give you the clearest view. Today, wow, we are looking at a number that just sounds huge, almost unreal. Bitcoin hitting $1 million. A million per coin.
It is, yeah. It's an audacious target. And what makes this one really interesting, I think, is who is making the claim. We're not just hearing this from, some anonymous crypto account. This is Pavel Durov.
Right, the CEO and co-founder of Telegram. That's a platform with, over 900 million users now?
Yeah.
Massive.
Exactly. So his reach is just enormous. And he's not just some guy commenting on finance. He understands networks. He built one of the biggest. So when he says publicly he believes Bitcoin will hit $1 million, well, people listen. It comes from a place of understanding technology, network effects.
It carries weight, definitely.
Yeah, and he's basing it on, the core ideas of Bitcoin, decentralization, the security from cryptography, and its role as a digital value storage, especially when you compare it to regular fiat currencies and, inflation.
Okay, so our mission today is pretty clear then. We need to take this really bullish long-term prediction and just dissect it. We'll look at the arguments for it, scarcity, adoption, the bigger economic picture, and then crucially, we have to balance that. We need to bring in the skepticism, the academic critiques, the market risks, the hurdles. So for you listening, this is the shortcut to really getting the structural debate behind that big headline number. All right, so if we're talking about $1 million Bitcoin, the argument has to rest on things that normal money, fiat currency just can't copy. And the biggest one, the strongest pillar, seems to be scarcity.
It's absolutely the foundation. Unlike government money, which, can be printed, Bitcoin has a hard limit baked into its code, a maximum supply ever of just 21 million coins. That fixed cap creates this unique digital scarcity. There's nothing else quite like it in finance today.
And working right alongside that fixed cap is the halving, that famous mechanism that's built right in.
Precisely. So roughly every 4 years, the reward miners get for, processing transactions and keeping the network secure, it gets cut in half automatically. This means fewer new Bitcoins enter the market over time. It's like a built-in supply shock designed to make it deflationary.
And that program scarcity, that predictable reduction in new supply, that led directly to the stock-to-flow model, right? The S2F, often linked to Plan B.
Yeah, the S2F model. It basically suggests that as this scarcity increases, measured by dividing the existing stock by the new flow, the price should, go up dramatically in a predictable way.
It sounds compelling, almost like a formula.
It is a compelling story, but we need to pump the brakes slightly here, even in this section, just to set the stage for the counter-arguments later. While S2F is super popular in the crypto world, our sources point out that mainstream economists are pretty skeptical. They argue it's maybe too simple.
Too simplistic for such a complex asset.
Right. Lacking statistical robustness is the usual critique. We'll get more into that.
Understood. Okay, let's put a pin in that and move to the second pillar, institutional legitimacy and adoption. Because this feels like where the rubber really meets the road for Durov's idea. This isn't just enthusiasts anymore.
Oh, absolutely. That shift, maybe starting around 2020, has been fundamental. Bitcoin went from being this sort of fringe asset to something discussed in boardrooms. You've got big public companies like MicroStrategy holding billions of dollars worth on their balance sheets. And, maybe even more importantly, you have the giant global fund manager stepping in. Think BlackRock, Fidelity. These aren't small players.
And the approval of the spot ETFs in the U.S. earlier this year, 2024, that just feels like a watershed moment. You have to stress that, right?
Absolutely critical. Probably the single biggest milestone recently. The ETFs didn't just create a new product. They created a regulated, secure, easy way to invest. So now financial advisors can suggest it to clients. Pension funds can start thinking about putting a small percentage in. Institutions can get exposure without worrying about, holding the private keys themselves.
It's a huge stamp of approval.
Yeah.
Legitimacy.
Exactly. And it opens the door for potentially massive sustained demand, real capital inflows.
Okay, pillar 3 then, macroeconomic drivers. How does this digital gold idea fit into what's happening globally with economies?
Well, this ties right back to what we said about fiat currencies. When central banks like the Fed in the US or the ECB in Europe keep stimulating the economy, printing money essentially, it tends to devalue the currency over time. Inflation erodes purchasing power. Bitcoin, with its fixed supply, offers a mathematical alternative, a potential hedge.
A way to preserve wealth outside the traditional system.
That's the argument, a tool that isn't controlled by any government or central bank.
And we can actually see this playing out in some places already, can't we? It's not just theory.
No, it's not. The source material highlights real use cases in countries facing extreme economic hardship. Think hyperinflation in Venezuela or Argentina, or strict capital controls like in Nigeria. For people there, Bitcoin isn't just speculation, it can be a lifeline, a way to protect savings from being wiped out or seized.
So that real-world usage, that organic demand, kind of pushes back against the idea that it's just a speculative bubble.
It's a powerful counterpoint, yeah. It shows utility beyond just investment. Okay, so the bullish case is clear. Scarcity, adoption, macro trends. But to really grasp the $1 million idea, we absolutely have to look at the other side. The critiques from traditional finance and economics. And the first big problem is, how do you even value this thing?
Right, because traditional assets, stocks, bonds, they have a playbook for valuation. Bitcoin doesn't really fit, does it?
That's the core issue. Standard finance relies heavily on things like discounted cash flows, DCF. You look at the money an asset is expected to generate in the future, profits, dividends, interest payments, and calculate its present value. Bitcoin doesn't generate any cash flow, no revenue, no earnings, no dividends. So that standard toolkit, it just doesn't apply. There's no widely accepted fundamental valuation model.
So if you can't value it based on fundamentals like cash flow, what actually drives the price?
It ends up being driven almost entirely by supply and demand in the market, which means it's heavily influenced by sentiment, expectations, news, speculation, basically.
And that leads directly to the volatility we always hear about.
Exactly. It makes the price inherently unstable,
Yeah.
prone to huge swings, both up and down. Critics would say it's perpetually vulnerable to bubbles.
Which naturally gets regulators nervous. We've seen warnings from big institutions about crypto, haven't we?
We certainly have. You have to consider bodies like the BIS, the Bank of International Settlements, kind of like the central bank for central banks. They've issued repeated warnings about crypto assets, their main worries. Potential risks to financial stability, use in illicit activities like money laundering, and a real lack of consumer protection in many parts of the market.
And a warning from the BIS isn't something you just ignore.
No, it carries significant global influence.
Okay, let's circle back to that stock-to-flow model we talked about earlier. We mentioned there was pushback. Can you unpack that critique a bit more?
Sure. So our sources point to academic challenges, like a notable study from Erasmus University in Rotterdam. They looked closely at the S2F model's statistical reliability. The main criticism revolves around something called overfitting.
Overfitting. What does that mean for predicting Bitcoin's price?
It basically means the model looks great when you apply it to past data. It seems to match the historical price movements almost perfectly. But the researchers argued this might just be a coincidence, a spurious correlation. It looks good in the rearview mirror, but the mathematical relationship might not actually have the predictive power needed to forecast the future accurately.
So just because it worked before doesn't mean it caused the price rise or will work again.
Precisely. Past performance isn't necessarily indicative of future results, especially if the model is just fitting noise rather than a true underlying driver.
That definitely highlights the gap between a catchy market story and rigorous analysis. And speaking of strong views, there's the really extreme skepticism too, like from economist Nouriel Roubini.
Yes, Roubini. He famously called Bitcoin the biggest Ponzi scheme.
Which is a very provocative statement.
Extremely. Now, the source material is careful to point out that technically it's not a Ponzi scheme because it's decentralized, there's no central operator promising returns. But Roubini's comment really captures that deep-seated fear in traditional finance. Here's an asset that doesn't produce anything. Its value depends entirely on more people buying in later at higher prices. That skepticism is a major headwind for the $1 million idea.
Okay, so we have this tension. The program scarcity and big institutions getting involved on one side, and the lack of traditional valuation methods, the volatility and regulatory skepticism on the other. For Bitcoin to actually hit $1 million, some pretty huge things need to happen, right? What are the absolute must-haves?
Well, first off, just think about the market cap. To reach $1 million per coin, Bitcoin's total value would need to be enormous, comparable to or even exceeding gold's market cap. This needs what the sources call massive capital allocation. We're talking about the world's biggest money managers, hedge funds, sovereign wealth funds, those giant pension funds, deciding to put a small but significant chunk, maybe 1% to 5% of their assets, into Bitcoin.
And that's not a one-off investment. That needs to be sustained.
Absolutely, sustained inflows over years. And alongside that, on the macro side, the conditions we discussed earlier need to persist. Continued global inflation chipping away at confidence in major currencies like the dollar and the euro. And critically, we need regulatory clarity and stability. Not a patchwork of confusing or hostile rules, but a global framework that allows Bitcoin to be integrated safely into the existing financial system.
Okay, let's dig into a potential paradox here. The tech itself, the scalability challenge. If you're mostly talking about Bitcoin as digital gold, a store of value, why does transaction speed or cost even matter that much?
Yeah.
Gold isn't fast or cheap to move.
That's a really sharp question. And it forces us to think beyond just storing wealth. While you're right, for large, infrequent store of value transfers, speed isn't the main issue. The path to a $1 million valuation likely requires much broader adoption, mass adoption. And for Bitcoin to be used more widely, maybe for smaller payments or more frequent transactions, it has to overcome its current limitations. It can be slow, and transaction fees can get really high when the network is busy.
So the main Bitcoin blockchain, Layer 1, has bottlenecks. What's the fix for that? How do you get it ready for potentially millions or billions of users?
The main hope lies in developing and deploying Layer 2 solutions. The most well-known example is the Lightning Network.
Okay, Layer 2, how does that work, basically?
Think of the main Bitcoin blockchain like a big, sometimes congested main road. Layer 2 solutions like Lightning are like building express lanes or side roads on top of that main road. They allow for many transactions to happen faster and much cheaper off the main chain, but still ultimately secured by it. This is seen as essential for enabling everyday use cases and scaling up.
Got it. Now let's pivot to what seems like maybe the biggest wild card, the biggest potential showstopper, regulation.
Regulation is almost certainly the single largest risk factor. The threat comes from its fragmented nature globally. Different countries, different rules. For instance, we have to look at the EU's MiCA framework markets and crypto assets. It's designed to be comprehensive, bring order.
Which sounds good. Clarity is good, right?
Clarity is good, but the details matter. Depending on how MiCA is implemented, its requirements could be quite strict for exchanges, wallet providers, stablecoins. It could potentially stifle innovation or make it harder to operate across Europe, impacting global liquidity.
And things aren't exactly crystal clear in the U.S. either.
Not at all. That ongoing uncertainty, is it a security regulated by the SEC, a commodity under the CFTC? How is it taxed? This lack of a clear federal framework makes big institutions hesitant. They need predictability. That slows down the institutional adoption we were talking about.
Okay, regulation is huge. What about competition? Bitcoin isn't the only digital game in town anymore.
No, it definitely isn't. Competition comes from two main directions, really. First, you have the potential rise of central bank digital currencies, CBDCs. If countries like China or maybe the US or Europe launch their own official digital currencies, they could be very efficient, government-backed. That might chip away at Bitcoin's use case, especially for payments or as an alternative to unstable national currencies.
Okay, so government competition. What about other cryptos?
Then you have the decentralized competition, most notably Ethereum. Ethereum isn't just trying to be digital money, it's a platform for applications, for smart contracts, decentralized finance, DeFi, NFTs. It offers much broader utility. So the question becomes, will investors prefer Bitcoin's simplicity as digital gold, or will they be drawn to platforms like Ethereum that do more?
Right, and one last challenge we have to mention, it always comes up, the energy debate.
Yes. The energy consumption of Bitcoin mining. It's a constant PR battle, and a political one, too. Now, the source material does suggest there's a significant and growing trend towards using renewable energy, or energy that would otherwise be wasted, for mining. But the perception of Bitcoin as environmentally damaging persists, and that perception gives ammunition to politicians or regulators who might want to restrict mining activities. Overcoming that narrative is still a major hurdle for mainstream acceptance. Hashtag tag outro.
So when we pull it all together, Durov's very bullish network-focused view on one side, and then all this caution from traditional finance, regulators, and the tech challenges on the other, what we end up with is a $1 million target that seems, well, plausible within its own logic, but facing a really, really difficult path.
Exactly. The core arguments around scarcity and the undeniable trend of institutional adoption provide a strong theoretical foundation. But you absolutely have to weigh that against the volatility, the lack of a standard valuation model, and these significant operational and regulatory hurdles we've discussed. Durov's statement ultimately feels less like a precise short-term price prediction and more like an expression of a very long-term belief in the digital gold idea applied to a powerful digital network.
Okay, so that leaves us, and you the listener, with a final thought to chew on. The road to $1 million, if it exists, is clearly complex and uncertain. But maybe the key question is, Which specific challenge is the most critical? What's the biggest potential deal breaker? Is it regulation? Will global frameworks, particularly things like MiCA in Europe, end up integrating Bitcoin or effectively restricting it?
Or is it the technology itself? Will those layer 2 solutions like the Lightning Network truly deliver the scalability needed for mass adoption without compromising Bitcoin's core principles?
Yeah, it really boils down to that fundamental tension, doesn't it? The tension between the stability and control that regulators want and the decentralization that gives Bitcoin its unique value proposition in the first place. Successfully navigating that tension, bridging that gap, seems absolutely essential for Bitcoin's long-term trajectory, whatever the ultimate price turns out to be.